Okay, let's move on to Michael Burry shorting NVIDIA and Palantir. Why don't you tee it up and talk about it? I'm going to try to connect my headphones because my
Okay.
ears are cold.
Okay. So, um, I'm gonna pretend like you can hear me the whole time. So I assume you will be able to.
Yeah.
Okay. So his premise on shorting AI and specifically picking on NVIDIA and Palantir is that the NVIDIA chips are being bought in these massive clusters that are being depreciated over a 6-year time frame, but the chip's life cycle is probably not 6 years. It's probably only 1 or 2 years. That's his speculation, and therefore the 6-year depreciation of these assets is too long. So when, for example, let's say Meta says they're going to spend $60 billion on these data centers this year, what that really means is that only $10 billion of that 60 billion is going to get depreciated this year, and then another 10 billion next year, and another 10 billion the following year, and so on. But they spend the 60 this year, so their cash flow wise, it's a pretty significant hit. And he's like partially right. The cash flow hit is pretty real and it's immediate. But these companies' cash flows are so large that they can absorb that $60 billion hit in the given year that they're doing it,
Yep.
but they're depreciating it over 6 years, so their profits continue to be pretty substantially higher than the cash flow would indicate. So, you know, there's something there. There's like I would say there's a valid concern there. If these data centers don't last them 6 years and they got to be replaced with newer chips because they're so much more efficient 3 years from now, and all of a sudden you have to take 3 years of depreciation in 1 year. Now all of a sudden you're taking that $30 billion hit in the year in the future year that you might depreciate all those assets. So if he's right, there would be some accelerated depreciation that happens in the future. But these guys are not dumb. The companies that are taking these depreciations, they're not dumb. They're not short term thinkers. Google, Microsoft, Meta, etc., are not short term thinkers. They're not like thinking, oh, let's play with accounting because we're not going to be here 6 years from now or 10 years from now. These guys are all planning very long term companies, and chances are the 6-year depreciation is perfectly valid. And 6 years from now, those data centers are going to continue to function with the same hardware that they put into them today, or maybe some percentage or high level of percentage of hardware that they put into them today. So on his concern for NVIDIA, I don't share that same concern. Now, if we move on to Palantir, here's a different scenario, and it might be worth actually looking at, the fundamentals of these companies. So, if we look at sort of NVIDIA, here's NVIDIA's, market cap is 4.4 trillion. Its PE is 43, right? This is its trailing 12-month PE. Price sales is pretty high, but the PE is way more important. And its revenue run rate for the trailing 12 months is
Can you
187
zoom in?
billion. Oh yeah, let me um, here. So hopefully this is a little bit more clear.
Correct.
The revenue run rate of NVIDIA is 187 billion with a 65% growth rate. Now, if these companies slow down and stop spending as much, and NVIDIA's growth rate becomes like 20%, similar to like Meta or Microsoft or whatever, then a 43 PE might be a little high. Um, but chances are it's going to continue to grow at a faster pace than Meta and Google and Microsoft have been, and therefore this 43 PE seems very justifiable to me. Now, I'm not a Nvidia shareholder, and therefore I have like no skin in the game. I'm like trying to be like very, not like non-biased. I'm not actually biased. And if we look at Palantir, which is his sort of like other short bet, this is a totally different story, because here's a company that has almost a $400 billion market cap, 395. So we'll just round it to 400, with a $4 billion revenue run rate and 47% growth rate. So even if you take this 47% growth rate, and let's say we'll generously give them 50% growth rate for the next 3 years, right? That means the 4 billion grows to 6 billion, the 6 billion grows to 9 billion, the 9 billion grows to, 13.5 billion in 3 years. So should a $13.5 billion company be worth 400 billion? I don't know of too many those kind of ratios where a $13.5 billion revenue company is getting a price sales ratio of 30, right? So in that scenario where Palantir is growing at 50% annualized for the next 3 years, 3 years from now, its price sales ratio is pretty high for today's stock price. So, and this is, Palantir being off by like roughly 20% from its highs too. So, his short bet on Palantir seems to me a lot more justifiable than his short bet on NVIDIA. So, that would be my take on his sort of AI bubble position. The other
What's
sort
his
of like, yeah,
what's his
go ahead.
reasoning for shorting Palantir? Is it
Just to,
strictly PE?
I think it's just the numbers being like so high, like it is astronomical. No, I think Palantir might be breaking all the sort of like rules in terms of a solid
All the laws
company
of
that is,
physics. Yeah.
yeah, the laws of finance. Um, for a solid, mature company that's a multi-billion-dollar revenue company with profit, it's profitable. There's like Palantir is not going out of business. Just to be clear, like this is not a company that's at risk of like disappearing. But there's lots of examples of companies, and we've looked at some of them in the past where if we look at, for example, Atlassian, Atlassian was one of these darlings, and I forget their tickers, team, was one of these darlings where, the price sales ratio and stuff had gotten way ahead um, of its performance at the time. So if we go to like its earnings, you can kind of see this company has been growing rapidly on a continuous basis for the past this is the past 4 years. And we can even go like longer. Here's like the 10-year. This is a beautiful chart. This is basically what Palantir's growth chart looks like. But if we look at their sort of stock price for the past 5 years, they grew rapidly to like a $400, 400 and what was it here? $450 price point. And today you can buy the stock at $150 or less than $150. And the reason for that is because it just had gotten way out of whack up here with price sales ratios that were nowhere close to Palantir's, but way too high for a typical SaaS
Right.
company. So, so there's lots of examples of companies where they eventually come back down to earth in terms of price sales and price earnings ratios. So you can only escape that for so long.
Yeah. I agree with you. I mean, I don't know enough on the uh, depreciation side of things to
Mm,
know what's real, what's not. Because to me, it's all like I just need to trust a source.
right.
Um, but with that said, I don't like. It's a fallacy to believe because Michael Burry got the housing crisis right that he's going to get this AI bubble right, or even
Right.
Palantir right, even if we believe, that they are overvalued.
He's actually been
Um,
pretty notorious for getting things wrong since then. I think the running
well, I
joke
think
is that he's predicted 17 of the last two
it,
bear markets.
yeah, I mean, it's very difficult to get things right consistently. That's what makes investing difficult, right? So, like,
Right.
and I'm not like, he's a very smart guy. It's just the nature of the beast.
Right.
So I don't really give it a lot of weight personally.